So with that, I'm going to drop my screen and I'm going to bring on our two presenters today, Adam and Cameron from CNIS. We're so happy to have you joining us, and I'll let you bring up your slides. Let me know when you're ready there. Looks like you
All
started.
set.
Great. All right, guys. Well, thanks for joining us. Always nice to see you. I'm going to turn the floor over to you, and then join you on the back end to help with Q&A. And if anyone is experiencing any technical difficulties during the event, please feel free to reach out to me, Robert Gibbons. Just shoot me a chat in the chat box, and I'll be happy to help. All right, guys, all yours.
Appreciate it. Thank you, Robert. Really appreciate it. Really happy to be here today. Thank you all so much for joining us. It's always great to see a lot of familiar names and organizations in the chat. Lots of clients, lots of members. That's really awesome. We appreciate you being here. CalNonprofits Insurance Services is a wholly owned subsidiary of CalNonprofits, so that's really important to us. We're a mission aligned organization. Our profitability fuels and funds all of that great advocacy work that Robert was talking about at Cal Nonprofits. So a really amazing partnership that we're very happy to support. For us, being a broker is a tremendous responsibility. In our view, your broker is really your representative and advocate for all the insurance options that exist. So our goal is always to help you find the best possible coverage, including some of the alternative funding mechanisms that we're going to cover today. So a lot of times a broker can be confused with a carrier. We're not the carrier. We're not the ones underwriting your risk, but we are the ones advocating for you with those carriers, making sure that you understand all of those options and that we're there to really work on your behalf, be your representative to the insurance industry and help address your organization's unique needs. Cameron Ghazzagh, our director of employee benefits, has a tremendous amount of experience in this space, more than 15 years on both the agency and broker and carrier side. So really happy to bring his expertise and experience to you all today. I think we've got a lot of really effective and informative content for you. So just to kind of help set the stage for us, Cameron, um, everybody I think on this call is familiar that it's probably never been more challenging to provide quality, affordable employee benefits to your team. Can you help us get a little lay of the land and understand what's really driving that right now?
Yeah, and thank you, Robert, for hosting, and great to see everybody. This is an interesting topic because if you rewind about 20 or 30 years, the proportion of spending for an employer on medical benefits and benefits as a whole was relatively smaller. It's always been a larger portion of the expenses after payroll, but as time has gone on, it has increased more and more, and it's putting an incredible amount of pressure on employers, especially in the nonprofit sector. And for those wondering, the increase in cost is absolutely not consistent with inflation. It's outpacing inflation. And that's a real problem if it continues. And unfortunately, the signs do point to it continuing for the foreseeable future. So, what are the drivers? Well, medications are huge. So, GLP-1s are one of the larger drivers, but it's not just GLP-1s, it's oncology medication, immunology. There are rare disease gene therapies that are relatively new and biologics. And all of these things are contributing to just an increase. And I think when I checked previously, about 10 years ago, RX was about 10% of overall medical costs. Now it's creeping up to almost 30% in some cases. So it's really a big part of the increase in costs. It's not the only increase in cost, but it's one of the more fast paced ones. Now,
Yeah.
yeah, go ahead, Adam.
No, it's really good context just to keep in mind that it's healthcare utilization and the cost of those services and medications that's really behind the cost of insurance. But I know you recently had gotten updates from most of the major carriers in California. We can give everybody a little bit of a preview of what 2027 is looking like.
Yes, and I'll just mention too, employers are looking at more affordable ways to do things, and we'll talk a little bit about some strategies to do that. And a couple other things to mention about the current landscape is the demand for behavioral health services is increasing. We know that there's lots of services out there that are attempting to address it in some ways. Companies like BetterHelp are great examples of that, and they certainly have a place. But there really is no one solution to some of these problems. It's very multifaceted, they're complex, and they require usually fairly unique strategies. So it's not one, never going to be really one blanket strategy that works for all employers. It'll be fairly custom, even for small employer groups. Okay, so about Q4, this is fresh off the press. This was released just about a week and a half ago. And as you can see, these numbers at the bottom are percentages. The carriers are putting out incredibly high increases. If you think about inflation, if you think about your own paychecks and your employees' paychecks, they are not going up consistent, most likely not going up consistent with some of these increases. And again, this is not a fluke. This has been happening now quite a bit for the last several years, and all the best evidence suggests that this is likely to continue. Now, a couple standouts here I just want to point to. So, United Healthcare and Health Net are certainly on the upper end of this. They're showing for both their HMO and PPO plans, especially PPO, are showing close to 22 to 24% pressure, which is incredible. And then Kaiser, on the other hand, is showing comparatively better increases. So it's around 7%, although even a 7% increase, if you think about it. So think about a 7% increase, which is the lowest increase that we're seeing on this chart. Even that most likely outpaces most paychecks. So it's very significant, even on the low end of things.
Yeah, it's really it'd be nice to see some relief in sight, but these trends have been persistent for some time. So we really want to get into, what are the strategies available to organizations to help navigate this landscape and deliver the best results. But we do know that insurance, like nonprofits, we love our jargon and our acronyms. So we want to spend just a moment to give everybody a little bit of time to get familiar with some of the terms we're going to be looking at, including, for example, the network types that we were just discussing on those rate increases a moment ago. No need to read these to everybody, Cameron, but is there anything here that you would specifically home in on as sort of common areas of confusion?
Yeah, and I do want to acknowledge, so employee benefits really is kind of its own alphabet soup. And so terms like HSA, HRA, ERISA, PEO, if they sound unfamiliar, that's normal. There are some that are more common than others, like HMO and PPO. But for those new to benefits or those just now looking to offer benefits to their employees, certainly many of these are going to be a little bit unclear. And so really, it's best to think about these terms in three general categories. The first is the way that employees access care. And the second is accounts or reimbursement arrangements. And the third is laws and organizational structures. So just as an example, ways employees access care, HMO, PPO, HMO being the health maintenance organization, closed network. So a set network that your employees can see doctors within. PPO, typically open network, can see almost any doctor. And then for the HSA, FSA, HRA, that falls under the accounts or reimbursement arrangements. And that's often tied to legal statutes and regulations. And then separately altogether, laws and organizational structures. The big one in that category is ERISA, which I'll talk a little bit about as well. But basically, we'll explain as we go which terms matter and why as they come up.
It's easy to lose your bearings, but we'll keep you following the right path as we move through this. So help us understand, Cameron, just at a high level, when we're talking about employee benefits, what are the really critical components of building an employee benefits plan?
Yeah, so when people think of employee benefits, typically medical is what comes up first and most significant, and rightfully so. Medical is often the most important component of an employee benefits plan. Often second or third is dental vision, and then things like life, disability, retirement, reimbursement arrangements. And then you can get into the category of the extras or the fluff, which is things like MetLife Legal has a legal protection program. Delta MetLife also has a pet insurance program. So there's a lot of different types of benefits that could be included. And in addition to the big carriers, now there's all these other companies like BetterHelp being one of them that want to come along and offer in mass a service to your employees. Often they're affordable. One warning about the health related programs. Over the last 15 years that I've been in the industry, and I am new to Cal Nonprofits, but I'm not new to the industry, I've aggressively looked for data that points to health-related programs actually changing material behaviors. So what do I mean by that? Regardless of the carrier, every carrier has their own health program. They're trying to reduce costs by getting people to stop smoking or eat healthier. Does it move the needle? The best possible data shows it might move the needle a tiny bit. So then you have to really decide, and not to get sidetracked on this topic, but it is important. You really have to decide whether that's worth it to you for the administrative burden and sometimes cost to implement and administer a program like that, even if it is mostly being administered by a third party. So just keep that in mind. I am keeping my eye closely on the market for a program that does have the ability somehow miraculously to change people's behavior in a way that actually changes health costs for that group. So where does ERISA fit? ERISA doesn't force employers to offer insurance. So that's a common misconception. It's not forcing employers to offer benefits. That's not what that piece of law does. However, once an employer does offer benefits, ERISA is really the primary federal law that governs it in partnership with, I think, the enforcement body is the Department of Labor. But it's also not the only one in play. And we'll talk about some of the others later. There's ACA, there's HIPAA in California, especially, but in other states, there's lots of state level laws and regulations and policies that apply to the employer related to healthcare. It's no surprise, health insurance, even dental and vision are some of the most highly regulated products in the country, almost on par with banking, almost on par with banking. But
Almost, yeah.
but all this really does sound scarier than it is. I don't want to put anybody off. A lot of this, I think the most prudent way to approach it is to avoid issues. If you're acting in your employee's best interest and you have clear plan documents and communications, generally that's a recipe for avoiding any mistakes. That said, it's absolutely a discussion you want to have with us as your broker, and we're happy to walk you through your program and point you to the right direction. There is a tool, by the way, called Mineral HR. We don't have a slide on it today because it really can be its own presentation. But it's an excellent tool for those who want to learn more, who may need help with compliance. Please reach out to us, and we're happy to share some more information about Mineral HR with you.
Yeah, a resource provided to all Cal nonprofits members and CNIS clients, really useful tool. I think you touched on a really important part, which is, a lot of times there's so much eagerness to provide a benefits package that it can be easy to sort of have the cart come before the horse. And as you were sort of describing a moment ago, really what's critical to having a plan that works for your organization and delivers the quality that you're looking for is to ensure that you have the foundation in place to build the benefits program that's right for your organization.
Yes, absolutely. And I'll mention too around governance. Governance is really important. We have in any organization, there's delegated responsibility, but especially so for nonprofits, it can often be a confusing point where the employer isn't clear off the bat as to who makes the decisions and if those decisions need approval by, for example, the board of directors or maybe some trustees. So that's a really important early step to take, but there are a number of steps to go through. And again, this is not something you have to do alone. In some cases, we as your broker can help you with this, or in other cases, such as getting governance approval perhaps from your board, we can at least give you some guidance, even if we can't do it for you. But really, the first step, kind of going chronologically, is to define a goal and budget. And oftentimes the budget's actually the most important part. In an ideal world, every organization would want to offer platinum plus level benefits to all of their employees and dependents and cover it all at 100%. But of course, that's not realistic. And so it's always going to be a little bit of a balance between cost and the richness of what's being offered. So if you're in a department or in an industry where recruitment and retention is very difficult, if there's not a lot of talent out there and it's expected that rich benefits be offered, then perhaps the goal up front really is to offer rich benefits and deal with the financial issue in another way, maybe removing from something else. So you define the budget and then you define the goals, and of course they're interrelated. And then the next step is to really decide eligibility. So who's eligible? How many hours do they have to work? Where do they have to get care? Where do they live? There's all sorts of criteria that fall under what you can decide as eligibility. Now, not to be confused with the carrier's eligibility requirements. The carriers themselves also can have eligibility requirements in some ways, usually almost often around geography, but you do have a certain number of decisions to make as an organization around eligibility. Then choosing benefit strategy. So you've defined the goal and budget. Now you want to decide what levels of plan to offer. Now, we have seen at Cal Nonprofits, and there's some of our employees on the call, we've seen employers with 3 or 4 employees offering 20 different plan designs within, for example, Cal Choice. Now, that's a possibility, and I know we all like to go to the Cheesecake Factory where the menu is humongous, but it is overwhelming, and that's generally not, especially when it comes to health insurance, which can be fairly stressful, generally not the best strategy. The simplest strategy for most groups, not all groups, but for most groups, is to pick a low, mid, and a high plan. And what do I mean by those? A low plan is often a bronze level plan or maybe a low silver plan that has a high deductible and maybe would be popular with somebody who's 26 years old, doesn't have medical conditions. And so why offer just a platinum plan when that 26-year-old just doesn't need it? That's just classic over purchasing insurance. Then a mid plan, maybe there's a low deductible of $500 and fairly medium copays. Maybe it's $25 to $50 to see your doctor. And then finally, a high plan. This is usually a platinum level plan where the copays are low. There's typically no deductible at all. And the great part about that strategy is if you have enough employees, it kind of allows people to filter and gravitate towards the one that fits them the best, again, without feeling really overwhelmed. In a scenario where you're offering multiple carriers, typically you can also offer the low, mid, and high options within each carrier. So you can allow somebody to select Kaiser and do a mid plan within Kaiser, or perhaps the following year they want to move to Anthem or Blue Shield, and the same 3 options are available in that carrier. So I spent a little bit more time than intended on that, but I think it is important. At that point, when you've kind of decided what you might want, then you're welcome to come to us. Again, by the way, all of these steps, you're welcome to come to us for help, advice, guidance. But one part of what we really do well is getting quotes, comparing quotes, and then customizing them based on your needs. So customizing as in what I just described, whether it should be a low, medium, high, or some other arrangement. And of course, geography is a big one. Post-COVID, we have employees all over the state, and I know many of our clients have employees outside of the state, living in Montana, Texas, New York, and the strategy does need special attention in those cases. The next step after that is to get governance approval. So again, very often you will need to go to your board of directors if you're a nonprofit to get approval, but you want to be ready for that. You want to have the quotes ready for that. You want to have all the ducks in a row and then go to them for approval. After that, there are that's oftentimes where the ERISA requirements come in with setting up plan documents and compliance. A tip I have around this is to keep a compliance calendar. So somebody, whoever the designated person is, it doesn't have to be somebody whose title is compliance officer, but somebody should be designated to manage the compliance calendar. Then the next would be setting up payroll and administration. And then finally, this is really important and sometimes leads to a little bit of chaos, is communicate clearly with your employees. So what are the options? How much is it going to cost them, et cetera, et cetera.
Yeah, that communication and clarity is really critical. Well, thank you, Cameron. I think that, laying that groundwork is really an important step. And a lot of times where things do become overwhelming for an organization. I know there's been a lot of conversation in the news around what's happening with the Affordable Care Act, and obviously a lot of folks who are looking at employee benefits are familiar with those Affordable Care Act components. Can you help us understand a little bit more about some of the recent changes and how that's affecting employers?
Yep, absolutely. So the big news here, because has led to a lot of confusion, is the big news is the ACA employer mandate remains in full effect. It's in place. So it hasn't gone away. What has changed is the federal subsidies. So the marketplace federal subsidies have that part has changed, and they say that help still exists, but it's not what it was before. So those who were perhaps getting individual coverage through the exchange, and maybe they were on a $600 a month plan, but with subsidies they were paying $400 a month. Generally speaking, they're not going to get that same level of subsidization as they were previously. When I talk about the mandate remaining in full effect, what do I mean? Well, the 2026 affordability threshold is still, I believe, 9.96%. So that requires applicable employers, and that's typically employers with 50 or more employees, to continue monitoring employee contribution levels. But there are still obligations for all employers. So I don't want to be too specific because it really just depends on the specific audience members situation. California, on the other hand, continues to maintain a strong ACA framework. So what many of us have seen who've been following both federal and local politics is, as the federal government has made changes, the state of California has often made changes to try to fill gaps or counterbalance certain things that are happening on a federal level. So it's a really important thing to keep your eye on. Another note, as your brokers, we have newsletters that go out keeping you up to date on a lot of this work. And a lot of this great work on the state level and even some federal level work is done by our parent organization. So thank you again for all the work that you do, Robert. One reminder on stipends, I think this warrants a clarification. So stipends are not the same thing as HRAs. This was, especially in 2022, 2023, for whatever reason, a big point of confusion. An HRA is a very formal employer-sponsored health plan. It's a very structured arrangement. A stipend is simpler oftentimes, but it's taxable, and it's really the big downside. Generally speaking, when we have assessed or helped clients assess stipends versus HRAs, it's rare for stipends to make sense all said and done. Now, there are cases out there where it could make sense, but there are big ifs and buts about it. And so we can't just say, you know, we can't just say you'll give an employee $300 a month stipend to buy insurance. That generally doesn't work, but there are some pathways to offering stipends, and sometimes certainly stipends in lieu of benefits.
Yeah, no, it's definitely important to understand those implications carefully. You talked about this a moment ago, but I want to zoom in on the probably one of the biggest design elements that an employer is going to contend with is the contribution strategy. Who's paying which portion of those premium costs, and how do you define that? Can you tell us a little bit more about that?
Yes, this absolutely warrants a deep dive. So, as part of the strategy, one of the decisions you have to make early on is around contribution strategy, and you're setting a precedent. So, yes, you can change the contribution strategy the following year. You can pull some back if budget is tight. But the best approach really is to start with something you can sustain as an organization and then decide the philosophy around that. So you don't want to be in a position where the first year out the gate, you want to do 100% for all employees' independence. And then the next year or the year after, you're looking at the budget and realizing, ooh, as we're growing and as we're hiring more employees, or as our income as an organization is fluctuating, this is going to be tricky to sustain. The other big unintended consequence sometimes, or downstream effect around contributions, is around dependence. So if you're an employer and you want to be very generous, and by the way, there's nothing wrong with offering 100% coverage for employee only, and in some cases for dependents. I've been part of several organizations that have done that for me. But at the same time, you have to acknowledge that one of the issues that's going to come up is potential issues is the dependents of those employees are more likely to double cover themselves unnecessarily, meaning they're overbuying insurance and effectively wasting premium dollars. Or just as an example, if there's one partner who works for your organization and another partner for, a county of San Francisco, well, the county of San Francisco also has very generous benefits. If you were to offer 100%, again, that spouse may be very likely to double cover unnecessarily, even if they hardly go to the doctor. But the incentive is there. So how do you solve that? Well, one is through changing the contribution so it's not 100% across the board. But another great strategy that's fairly common is to offer cash in lieu. So cash in lieu of benefits. I'm in this position. My partner works for a large organization that offers great benefits for both of us. So I'm able to waive coverage with CalNonprofits Insurance Services and get a certain portion of that back. It's a win-win because it offers a savings for your organization and offers a benefit to the employee. Couple other things too, really just mostly to summarize, you really want to pick a clear contribution strategy. I have seen these get overly complicated, especially if there's multiple plans and the benchmarking is a little bit awkward. You want to pick a simple strategy that's sustainable, that works, that's fair, and execute it and try to stick to it.
Yeah, I know I saw a question in the chat around this, but can we zoom in just a little bit on the distinction to clarify between HRA, HSA, and FSA? A lot of times those terms get used interchangeably.
Yeah, that's a great question. So HRA is a health reimbursement account. So there's a few features about this that are really important. One is often it's the employer that's putting in the money for the employee. So if the employee is on a HDHP plan, which is a plan that's IRS approved to be associated with HRA and HSA plans, then and it's almost always a high deductible. This is sometimes $2,000 deductibles. It can vary a little bit. But once you're on that plan, the employer can then put money into this HRA account for you, then you can use towards eligible expenses. And this is up to the IRS. There's a really long laundry list of items that you can use those funds for. Things like obviously prescription drugs, copays, that type of thing. And then of course some over-the-counter medications. FSA on the other, oh, and one other big feature about HRA is you use it or lose it. Typically, almost always, at the end of the year, if you don't use it, or at the end of the benefit period, if you don't use it, it gets lost. So the employee doesn't have access to that after a certain deadline. HSAs, on the other hand, are similar, but it's typically the employee's own money pre-tax getting put into this account, and it is portable, so they can take it from year to year, and they can take it away from them when they're leaving if and when they leave the organization. So HSAs are a fairly popular option, especially for younger folks who are maybe don't have a lot of healthcare spend, but want to use it as a mechanism to save money. And then finally, FSAs. So FSAs are flexible spending accounts. The way they're different is that the FSAs don't necessarily have to correspond with a certain plan design. So you can opt for a really rich platinum plan design, Platinum Plus, no deductible, still elect an FSA and contribute to it, usually through paycheck deductions. And then you typically get this debit card if you have a FSA administrator, and you can use that debit card to again make qualified purchases, not anywhere for anything, but for very specific things that are related to usually your healthcare. Great question.
Yeah, appreciate that. Well, you talked about this a bit earlier, but I do think it's worth a deeper dive. There's a pretty broad spectrum of funding options and sort of ways that you can secure your coverage. And there's trade-offs involved between cost, control, and risk. Can you really help us understand what does that spectrum look like and what might motivate an employer to choose one option over another?
Absolutely. So before I dive into what you're seeing on your screen here, I just want to say, often we'll have employers who get very high increases from their carriers come to us looking for a way to save a lot of money. Now, with our work, we have the potential of certainly saving you money through our RFP work and some other mechanisms. But sometimes we run into employers who are under the impression that there may be a pathway to get a 30% off coupon when it comes to their health insurance. And unfortunately, that just doesn't exist. And mostly because the increased cost of health insurance is primarily due to what we were discussing earlier, the increase in baseline costs to providers, hospitals, and of course, RX medications. These pharmaceutical companies are really, as a side note, really incentivized. The current model incentivizes them to look for treatments that require somebody to be on a drug for a prolonged period of time, sometimes their entire life, versus a course treatment or a cure. And so there's been this gravitational pull towards increase in prices. Now, with that said, there are alternatives that, with some trade-off, can save money. And what are these alternatives? Well, to start with, the one that's not the alternative to the traditional, but the fairly standard, is the fully insured. This is where you pay a set amount every month for your plan. The carrier, the insurance carrier, bears all the risk. And generally speaking, this is administratively the easiest way to go. PEO is one step a little bit further on the spectrum, and the spectrum isn't perfect, by the way, in terms of placement, but it generally does the job. PEO is a little bit different in the sense that you're still working with a fully insured situation typically, so you're paying a set amount every month for your employees. It's predictable, and it's something you can forecast for financially fairly easily. But it's a bundled pool. So that means if a handful of people in the pool that you're a part of, people at a company that you may have never met before or even heard of, end up with some serious medical conditions, that can increase the rates for everybody. So it's a little bit of a risk there. There are some other downsides about PEOs, which I'll get to in a moment, but I want to move on to captives. So captives is a little bit different. Captives, it's a shared stop loss layer. So you are effectively putting some skin in the game where you're saying, well, if whatever claims come in, I'll have a partial responsibility for it. Where is the responsibility stop? Well, typically with captive organizations that you can work with, they have a cap. And so if claims come in over a certain amount, you're generally protected over and above a certain amount. Now, I also want to mention these three options on the right here: captive, traditional level funded, and self-funded, are generally not good options for really small nonprofits. And generally, they won't even allow just small nonprofits, or small groups, I should say, to enter into these arrangements. I believe the last conversation we had with a captive resources organization, the minimum was 50 employees. There's traditional level funded, which is where you take, again, it's similar to captive, but you typically have to go find your own reinsurance or caps. And then there's finally self-funded, where you have the most skin in the game. This is best for very, very large employers who can hire consultants to assess and then help manage their risk. And even for them, oftentimes it doesn't work out. But this is where, if your employee ends up with a complex cancer diagnosis, you may end up with $1 million claim, and that can be catastrophic for smaller organizations. So I'll revisit PEOs for a moment and just say, joining a PEO is a very, very big commitment. There's a couple analogies I can use, but just to make things simple, you are essentially giving employer of record. It's a co-employment model, and you're giving employer of record to that PEO. Is that always a bad thing? No. There are some implications that I won't get into today for nonprofits, specifically when they join PEOs because of their nonprofit status. They're certainly not barring them from joining. It's not prohibitive entirely, but it does cause some complications you should be aware of. The other big issue with PEOs is getting out of PEOs. So there are entire consultant categories on LinkedIn whose their titles are PEO exit specialist, because when you enter a PEO, getting out of one is so complex that it really requires people who specialize in them. So I won't go too much into detail. Again, there is certainly a time and place for PEOs, and it's absolutely a discussion we're more than happy to have one-on-one as to whether it's a good fit for you. But just a heads up, that is one We do often get messages back from people who we used to help saying, "Ooh, I joined this PEO. I didn't realize XYZ. Can I come back?" And of course, we help them as best as we can, but it is administratively very difficult.
Yeah, I think that that's probably one of the key points to emphasize is that where some of these alternative options do provide benefit, that's typically over a long period of time. So it's not a scenario where you can kind of jump from one solution to another each year. You really need to put some time and energy into understanding what's going to be the most beneficial to your organization over the long term. I think that's a great segue to our next topic, which is, can you tell us just a little bit about some of the other employer pitfalls that we encounter and things that leaders should be aware of?
Yes, so a lot of this is the opposite of what I was advising earlier. So first is shopping before a strategy. It can be really tempting to want to go get rates or go online and see what you can find about certain carriers. You really want to start with the strategy we talked about earlier. Confusing stipends and HRAs is another big one. It can cause issues. Luckily, this has been less and less of an issue recently, but again, a couple years ago, it was a bigger issue. Ignoring governance. You don't want to end up in a situation where you're making decisions and decisions that maybe you didn't have the authority to make or that required delegation or approval. Documentation, by the way, is a really important part of that. You want to document everything as you go through the process. Too many plan choices. This is a very easy mistake to fall in, especially as an HR person. If you really care about your employees, you want to make sure everybody has the plan that fits them. It's very understandable to want to offer as many options as possible. But when you get to the point where one plan is almost identical to the other plan, but it's a $25 X-ray instead of a $20 X-ray, well, it really just forces the employee to spend a lot of time trying to discern between these plan designs, and it's not really in their best interest long term. As a side note, I'll also say, because we have a lot of HR people on the call, that the tendency of the individual employee is typically to overbuy insurance. Some people have the opposite tendency where they're like, oh, I'm never going to get sick. I'm just going to go on the HSA or waive coverage. But for most people, the studies show that the tendency is to over purchase insurance. So I would consider, as you're talking to your employees during open enrollment, try to make sure that they're not in that position where they're 26 years old with no health problems whatsoever, but choosing to pay $600 for a platinum plan. It's just not in anybody's best interest. Insurance companies love it, but it's not in the best interest of you or your employees typically. And then finally, an exit plan, for especially for these alternate funding mechanisms, arrangements, many of them do require a exit plan up front. You don't want to end up in a PEO without knowing how you're going to get out. So that's something else to certainly think about early on.
Yeah, it's good to know the entrance and the exit in advance, have that planned out. Um, Can you tell us a little bit more about those really critical decision-making components and the things that you would really emphasize that people not overlook or skip?
Yes. So if you're going into the process of considering to offer benefits to your employees without fully understanding your organization's financial situation, that's typically a mistake. So again, after payroll, employee benefits are the number two the largest expenditure that employer makes. So after payroll, typically that's number two. So being very well aware of not only the current year's budget, but also projections for future years. And I know that's difficult, which is why it's sometimes better to start a little bit leaner and maybe later on start upping the contribution level or start upping the benefit plan designs or the generosity in general over time versus starting out the gate very generous and then pulling back later. From the employee's perspective, that often feels just it's an emotional thing, but it feels like something's being taken away from them. And it doesn't feel as good as maybe getting a little bit of a bump later if it's appropriate. Being aware, you don't have to be a PhD level expert. None of us really are on ERISA, ACA, HIPAA, COBRA. I think if you took all of these laws and stacked them up, it would probably exceed the height of the redwood tree outside my window here. They are huge and nobody's expected to know them, but there are tools and resources to help you. So utilize those early on, whether it's your broker or Mineral HR is most likely where we're going to point you. Definitely be very well aware of those applicable rules on a general basis. Again, not specifics, just be aware that they exist and generally what they do. Operational work is important. Again, exiting is very important. Whatever situation you're in, you want to know what your exit route is. And then vendor questions. So whether it's a carrier or a broker or your BetterHelp has reached out to you or some other carrier has reached out to you, you want to definitely ask a set of smart questions. And some of these are the questions that we would ask on your behalf if we were your broker and operating with the carriers.
Yeah, really be informed. Know what you're getting into, and don't put yourself in a position to be surprised. Um, I've seen a little bit of conversation in the chat, and I think it's worth zooming in on. CalNonprofits Insurance Services is a full service agency and broker, but can you talk a little bit about how we're different than the other insurance agencies and brokers that people might have access to?
Yes, and actually, I'll start with the reason I came to Cal Nonprofits about 6 months ago. So I've worked for the carriers. I've worked for Kaiser Permanente, Sutter Health Plus, Amwins. I've worked for a little outfit called Canopy Health, which partnered with over 30 hospitals and medical groups in the Bay Area. So I've been around the block, and one thing that really attracted me to Cal Nonprofits is we're not for sale and certainly not for private equity. A very unfortunate trend that I'm seeing in our industry, and of course in other industries like veterinary services and restaurant groups and all that, is private equity is very quietly coming in and either investing or purchasing outright brokerage firms. And that's often leading to downstream effects, to worse service, to people disappearing and going to other companies. And so I think many of us are aware of the negative effects. I don't think they're controversial of private equity involvement in industries. That's not who we are fundamentally. And again, this is a big reason why I came to Cal Nonprofits is fundamentally we are nonprofit owned, and a huge part of our margins goes to advocacy work and research and policy making work that, in the grand scheme of things, helps not only California nonprofits, but as you and I have been learning, Adam, as we've been talking to out of state folks, other nonprofits as well. So we're really spreading the love through the work we're doing. But in addition to that, we have a great service model, and it is improving, by the way. There are some changes that are being made that I'm really excited about that'll allow us to be even more responsive than we have been before. I mentioned the nonprofit supporting. We have a lot of great exclusive programs, Mineral HR being just one of them. And incidentally, Mineral HR is coming out with an AI feature. I have mixed feelings about AI, but I do think the applications of AI around compliance and legal and HR are actually quite good and effective. So excited to share more about that. And then we have tons of resources. I mean, I think combined as an organization, and this is always a cliche, but we probably have over 1,000, years of combined experience as a brokerage firm, and we're really proud of that. Lots of value adds. I talked about some of them. I won't go into detail, but we'd love to talk to you one-on-one about anything that's on your mind or any challenges that your employer is facing.
Yeah, thank you, Cameron, for homing in on that. You talked about this early on that, sometimes the distinction between the broker and the carrier can be a little confusing, who is actually providing the coverage. But I think where we really bring a lot of value is just by having so much experience with nonprofit organizations and really being in a position to present your organization as favorably as possible to the insurance carriers that we work with, and make sure that you're getting the as much value as you possibly can from the program that you choose. Well, thank you so much, Cameron. Really appreciate it. We'll leave this up on the screen to ensure that our contact information is available for anybody who wants to follow up. But Robert, I know you've been monitoring the Q&A. We have about 10 minutes left. Do we want to dive into that?
Yeah, we've got some questions. And none of them, I think, are too specific for us not to talk about in this broader context. And I do appreciate you really making clear the distinction in services that you offer and why a nonprofit would be inclined to engage with your organization as opposed to a brokerage that specializes in the private sector. But at the very top here, we had a first question about how successful have you seen high deductible plans in combination with an HRA? And so we're going back to the very beginning. We were talking about HRAs and SAs and all that good stuff.
Yeah, this is such a great question. And thank you to whoever raised this, because this was a question that when I was at Kaiser, we asked, and we actually we had a research team at Kaiser, a whole consortium of consultants who looked into this very topic of HRA, or a deductible plan that's fully funded with an HRA versus a non-deductible plan. Why would one choose the other? What they found was there is a little bit of a difference between the cost of fully funding an HRA that has a, let's say, $1,500 or $2,000 deductible versus getting a $0 deductible plan and where the employer doesn't fund it. So there are some savings, but in some ways where the employer really does benefit from the HRA plans is for any funds not used at the end of the year, the employer gets to take that back. And so for the really young, healthy people, that arrangement could be pretty beneficial for everybody involved, the employer and the employee. You don't want to be in the position where necessarily where you're having a deductible so high that you're discouraging care. So you want to make sure your employees are very well aware of the fact that they have the HRA funds to work with. But yes, it's a great question. The answer is it's negligible, but it's meaningful enough that it can make a difference. Now, keep in mind too, administrative burden, right? When you have an HRA plan that's fully funding the deductible, there is an administrative burden associated with that that wouldn't be there if you went with a non-deductible plan. So hopefully that does a good job answering your question. But again, it's a great point.
Thanks so much, Cam. And yeah, there are two different questions. So I'm glad we touched on that. That makes it a lot clearer to me. And I will remind everyone that everyone will be receiving a recording of this event as well as the slides. And you are also very welcome and encouraged to reach out to Cameron and Adam for your more specific questions that might require a more nuanced answer. Um, but we have a question from Kevin about larger nonprofit organizations, and he asks, for larger nonprofits with more than, say, 100 employees, have you explored captives like Paratio Health to combat excessive rate increases and soaring costs?
Kevin, great question. So Pareto Health is a great is one of the many different captive options. We have not met one-on-one with Pareto yet, but I'm very well aware of Pareto. Um, Yes, it's something we would always want to look at if the employer were in a scenario where they were in desperate need of savings and they're willing to look at anything, no matter the administrative burden, and if they were eligible. Now, Kevin's hypothetical, this group has over 100, so more than likely they would be eligible, at least with that eligibility criteria. We as the broker, our goal is to first ask a lot of questions. So if a 100 life group nonprofit came to us, the first thing we would do is ask tons and tons of questions. What's your strategy? Where do your employees live? And we'll look over the census, we'll look over the data, historical data, the renewals historically, any claims data we would look at as well, if applicable. And based on those things, that's where our recommendations are really honed in. And that's really where we deliver value, is very group specific recommendations, not cookie cutter. Although otherwise you could go to any search engine or ChatGPT and get an easy answer on what plans you should choose. But it is a little bit more complicated than that right now.
Thanks, Cameron.
Mhm.
Jennifer asked this question earlier on, so I do just want to circle back to it. Noting, can you talk a little bit more about the risk of high stipends and what those risks might be?
Well, yeah, there are some more risks. It depends on a couple things. So it's very multifaceted, which is why if somebody is looking at doing stipends, please do reach out to me, because it's very dependent on the group size. It depends on the amount that you're trying to do a stipend for. It can depend on where your employees live as well, potentially. So I'm sorry I don't have a better answer for that, but definitely if you're looking at doing stipends, please reach out to us because we'd love to learn more about that specific situation.
Thanks, Cameron. Jennifer, I think you got your answer. It's time to set up a phone call with Cameron. Um, Stephen has a question about ICRHA programs and asking, is that something that you are able to set up?
We have looked at ICHRAs. In fact, I met a few weeks ago with somebody who specializes in these programs. I'm undecided, truthfully, around whether these programs actually make long-term sense and whether the trade-offs are worth it. So another great example, if this individual would like to reach out, I'd like to learn about their needs. ICRAs definitely can be an option for some people, I think some organizations, but I think when you compare it to the alternatives, it usually pales a little bit in comparison. So it just depends.
I would say one of the things we hear a lot in that conversation, for those who aren't familiar, an ICRA is basically a program where the employee receives funds to purchase insurance on their own via the individual exchange. And I think, especially given those ACA considerations that Cameron was discussing early on in the program, a lot of the challenge there is just deciding how much of that work and obligation you want to place on the individual to navigate these choices on their own versus providing them with something that you've designed to meet their needs that helps make that decision making process a little less fraught.
Yeah, I mean, yeah, well said, Adam. And thank you for defining ICRAs because it is slightly a lesser known acronym. But really, I guess the best way to put it is the biggest advantage of an ICRA can be budget control and employee choice. But the biggest disadvantage, and there are other disadvantages, but the biggest one really is that the employees have to navigate the individual market, which currently again doesn't offer, mostly doesn't offer the subsidies that were offered previously. And so it's certainly a different experience, can be a little bit more abrasive than a traditional group health plan. But again, I would certainly not rule it out uniformly for all groups.
And in that case, you would not have the assistance of a broker like yourselves, would you?
Well,
The
we
individual employee.
yeah, it's a great question. So we don't do a lot or perhaps any individual enrollments. There are brokers out there who can. Certainly, if that's a direction the employer wants to go, if we can't help them, we'll point them in a direction that can help them. There are smaller agencies out there that do mostly focus on individual plans.
That makes sense. In the same vein, Carly asks if you're considering offering staff the ability to take cash instead of insurance coverage. How do you make that equitable when everyone's cost of coverage is conceivably different?
Yeah, excellent question. So benchmarking is the simple way to put that. Of course, there's other strategies you can employ, but if you start with picking one plan that you consider the benchmark plan, and typically that's the lowest cost plan, you can use that as a basis for calculating the cash in lieu. Now, if you would normally, for an employee, for the lowest cost, let's say Kaiser plan, if you would normally be paying $600 a month per employee for that plan, perhaps the cash in lieu is 150, maybe $175 per month. When you're thinking about the number, you really want to not necessarily think about the least you can give them, but you want to be equitable about it. Of course, I'm sure that's the mentality of most people on this call, to be as fair and equitable of it as possible. But you're also trying to create a little bit of incentive. If you make the cash in lieu $20 a month or $25 a month, the consequence of that typically is people will still say, you know what, I'll be double covered. And then you're paying for a premium. They're getting unnecessarily double covered. And so it's really just dialing it in so it's very well balanced.
That makes sense. We've got time for one more question, and it's another question about trying to make these programs, packets, and benefits equitable among your employees who all have different needs. So Victoria asks, how do we provide some dependent coverage while maintaining equity among employees for a small group of, say, 25 folks? And I'm imagining what she's asking is, well, gosh, I'm gonna, some of these folks are going to receive, basically an additional benefit. But if I don't have a dependent, am I, receiving a detriment, a negative benefit, or
You know,
like,
I
what's the best way to think about that?
I completely understand the sentiment, completely understand it. In practice, I've never seen that actually a strategy employed to try to counterbalance the fact that some people might have,
Interesting.
some people don't. Now, the only thing I can think of that is somewhat related is almost always the dependent contribution amount is lower. Sometimes even zero, very rarely for nonprofits, but sometimes it is 0%. And so what that means is an employer might say, okay, all employees get 100, we pay for your health insurance, 100% of premiums for the base plan. In other words, for the benchmark plan, anything above that you have to buy up to. And for dependents, we're going to pay 50% perhaps. And yes, that is technically a little bit unfair to people who don't may not have kids or may not have dependents, active dependents. But it's not something I've personally ever seen attempted to be corrected somehow. But I do again understand the sentiment.
Great. Well, I think that takes us right to 12 o'clock. I appreciate both of your time today. That was a very well thought through and clear presentation of what can often feel like an intimidating subject matter to approach. So it was really wonderful to welcome you here today. And thank you also for taking the time to answer the questions in the chat. I've seen lots of folks in the chat saying thank you, helpful, very informative. Um, Once again, I will be sending out a follow-up email, and that will include the recording of this webinar, the slides that we've shown you, maybe some additional resources from CNIS, and then also Cameron and Adam's contact information so you can reach out to them directly to have a more in-depth conversation about your needs. Um, but thank you for joining both Cameron and Adam. That was excellent. We'll look forward to having you back soon. And thank you for all of the registrants for joining. It's great to hear what people are asking from the field and how we can better assist them as a team.